Welcome back to Bonnie's Life, the only place where we dissect the markets with absolute precision, stripping away the noise to give you the raw, unfiltered truth. If you are serious about understanding the deep mechanics of the crypto and global financial markets, hit that subscribe button, leave a comment, and let us dive into a week that has absolutely shaken the foundations of the digital asset space. This past week, from June 1st to June 6th, 2026, we witnessed a brutal reality check as Bitcoin plummeted from its weekly open near $76,000 down to a staggering $60,028. That is a devastating 21% wipeout in a matter of days. We are not just talking about a minor correction here. This was a massive deleveraging event that saw $1.8 billion in crypto liquidations, with over 72% of that pain absorbed by over-leveraged long positions. If you had invested a simple $100 spot position in Bitcoin at the start of the week, your portfolio would have bled down to $88.10. An Ethereum investment of $100 at $2,003 would now be sitting at $83.20. And Solana took the hardest hit, dropping your $100 down to $76.50 as it fell from $81 to $62. The Fear and Greed Index has plunged to a terrifying 13, signaling extreme fear, the kind of fear we have not seen since the depths of the 2022 bear market. Bitcoin crashed below its 200-day moving average for the first time since 2023, and the total crypto market capitalization has shed over $420 billion in just 6 trading days. So, what exactly triggered this aggressive market meltdown? We have to look beyond the charts and understand the fundamental and geopolitical forces at play. First, we saw an unprecedented 13-day streak of outflows from US spot Bitcoin ETFs, bleeding a staggering $4.33 billion from the market. Institutional investors are pulling back hard, and this was exacerbated when Strategy, a company famous for its never-sell ethos under Michael Saylor, liquidated 32 Bitcoin worth approximately $2.5 million. While that amount is a drop in their treasury bucket, the psychological impact shattered market confidence because it broke the narrative of unconditional institutional commitment. But the real heavy hitter this week was the escalating geopolitical crisis in the Middle East. The ongoing conflict between the United States and Iran reached a boiling point as Iran fired 7 ballistic missiles toward Kuwait and Bahrain, with US forces intercepting 6 of them. This direct confrontation, coupled with the continued closure of the Strait of Hormuz for 96 days, sent shockwaves through global markets. Oil prices surged wildly before pulling back on diplomatic rumors, but the damage to risk assets was already done. When geopolitical tensions flare to this magnitude, institutional capital flees from high beta risk assets like crypto and rotates into safe havens. Or in this particular case, into AI-driven technology stocks that are showing strong earnings momentum. However, even the technology sector was not immune to the macroeconomic turbulence this week. We saw the Nasdaq crash a full 4% on June 5th, marking its worst single-day performance since October 2025, while the S&P 500 lost a staggering $1.8 trillion in market capitalization. This was heavily influenced by Broadcom's disappointing earnings report, which triggered a massive semiconductor and broader tech sell-off that cascaded across all risk assets. Furthermore, the US May jobs report came in hotter than expected with 172,000 jobs added versus the 150,000 consensus estimate. A strong labor market sounds positive on the surface, but for markets it means the Federal Reserve has absolutely no incentive to cut interest rates. The CME FedWatch tool now shows a 96.2% probability that the Fed will hold rates steady at their upcoming June 16 to 17 FOMC meeting. This combination of persistently high interest rates, geopolitical instability, and institutional ETF outflows created a perfect storm, a convergence of negative catalysts that suffocated liquidity and drove the aggressive crypto sell-off we just witnessed. The 10-year Treasury yield rose to 4.29%, further tightening financial conditions and making risk assets less attractive relative to the guaranteed returns of government bonds. Looking ahead to the upcoming week of June 8th to the 14th, the market is bracing for a gauntlet of critical economic data that will dictate the next major move across all asset classes. Wednesday, June 10th, is the day you absolutely must mark on your calendar as we receive the May Consumer Price Index data. Economists are projecting headline inflation to rise by 0.5% month over month and 4.2% year over year, largely driven by the 18% surge in energy prices caused by the Middle East conflict disrupting global oil supply chains. If inflation comes in hotter than these already elevated projections, expect a violent downward reaction in crypto as rate cut hopes are completely decimated for the remainder of 2026. Following that, on Thursday, June 11th, we get the Producer Price Index and weekly jobless claims data, which will give us insight into whether inflation is being passed through the supply chain. Then on Friday, the University of Michigan Consumer Sentiment Report drops. And keep in mind that consumer sentiment hit an all-time low of 44.8 in May due to inflation fears and geopolitical anxiety. If the consumer is panicking, retail liquidity in the crypto market will continue to dry up because everyday investors simply cannot afford to allocate capital to speculative assets when their purchasing power is being eroded. On the crypto-specific front, next week presents a massive supply-side challenge that traders must navigate with exceptional care. We are facing over $1.8 billion in token unlocks throughout June, with a massive $715.9 million unlock for the RAIN token scheduled for June 10th, the same day as the CPI release, creating a potential double whammy of selling pressure. Additionally, the Solana ecosystem will see significant pressure with a 10 billion token unlock for Pump on June 12th. When millions of dollars worth of previously locked tokens flood the market, it naturally creates heavy selling pressure as early investors, venture capital firms, and project insiders take profits. This is not speculation. This is basic supply and demand economics. If you are holding altcoins with upcoming unlocks, you need to be exceptionally cautious and consider reducing your exposure before these events. This influx of supply, combined with the current low liquidity environment, extreme market fear at a fear and greed index of 13, and the absence of new institutional inflows, could easily trigger double-digit percentage drops in these specific assets. Smart money is already positioning for this. On-chain data shows whale wallets have been reducing altcoin exposure by 14% over the past 10 days. For the advanced traders and serious investors tuning in, let us map out the potential scenarios and technical triggers for the week ahead with probability-weighted analysis. Currently, Bitcoin is hovering dangerously close to the $60,000 psychological support level, with the relative strength index deeply oversold between 17 and 21 on the daily time frame. Levels we have not seen since the FTX collapse in November 2022. Scenario A, the bearish continuation, occurs if Wednesday's CPI data comes in hot above 4.2% year over year, and Bitcoin loses the $60,000 support on a daily close basis. If that critical level breaks with volume confirmation, we are looking at a rapid descent to the $58,000 support zone and potentially the $55,000 liquidity cluster, where significant buy orders are stacked according to CoinGlass liquidation heatmap data. The probability of this bearish scenario is currently sitting at 60%. Given the heavy macroeconomic headwinds and the absence of any positive catalyst on the horizon. Scenario B, the relief bounce, requires CPI to come in cooler than expected, below 4.0%, coupled with a meaningful de-escalation in the Middle East conflict. If Bitcoin can reclaim the 200-day moving average and push past the $65,000 resistance with strong volume, we could see a short squeeze targeting $68,000 as over $800 million in short positions would be liquidated above that level. The probability here is 40%. The options market is showing a max pain price of $77,500 for the June 26th expiry, meaning market makers have a structural incentive to push prices higher eventually, but the short-term trend remains firmly in the hands of the bears until we get clarity on inflation. In conclusion, we are navigating one of the most complex and treacherous market environments of 2026. The convergence of a hot U.S. labor market, sticky inflation driven by Middle Eastern oil supply disruptions, massive institutional ETF outflows, and a severe deleveraging event in crypto requires you to trade with absolute discipline and precision. Do not catch falling knives. Wait for confirmation of support at $60,000 with a strong daily close and rising volume, or a clear break above $65,000 with the 200-day moving average reclaimed before deploying heavy capital. Keep your eyes glued to the CPI print on Wednesday and monitor the Fed's rhetoric in the days that follow. Position sizing is everything in this environment. Risk no more than 2% of your portfolio on any single trade and always use stop losses. Thank you for joining me on Bonnie's Life. If you found this deep dive analysis valuable, make sure to like, subscribe, and share this video with fellow investors who need the real facts, not the hype. Drop a comment below with your predictions for Wednesday's CPI data and whether you think Bitcoin holds $60,000 or breaks down further. I will see you in the next episode as we continue to master these markets together. Stay disciplined, stay informed, and remember, In markets like these, capital preservation is the ultimate alpha.